now I can cost segregate it, right? So if I have the income and I want to take the income down, using a cost segregation study, this is when it's a great idea. When I have high bracket income, right? And I have a new rental property and I can cost segregate it and reduce my income in a high bracket arena. Because like I was telling you before, there's a big difference between taking, like in the example I used before, there was a big difference between taking it from $1 million to 600,000 than if you had taken it from 400,000 to zero, right? That difference could be like about 5% of a $400,000 deduction. That's 20 grand, right? So, so you got to always kind of look at that, like how much am I really saving by doing this cost segregation study, right? So a cost segregation study takes the component parts of a building and breaks it down into three distinct categories, right? We already talked about the land allocation. So you're going to have the regular building, right? That's typically the building envelope and all the walls and stuff that are in there. The tangible personal property is all the stuff that I can basically unplug, unscrew, somehow detach and walk out with, right? So it's kitchen cabinets, it's in a residential building, it's kitchen cabinets, it's sinks, vanities, tubs, toilets, the countertops, appliances, all of these things, decorative lighting, shelving, all of these things that I can do. And on a typical property, you're going to get, like on a good sized apartment building, you're probably going to get about 15% of the costs as tangible personal property. Land improvements are the biggest land improvements, basically the parking lot or the driveway, right? Because they're typically expensive. The land improvements can include fencing, sidewalks, like I said, the parking lot. If you have an apartment building with a pool, that would be considered a land improvement. Piping and stuff like in mobile home parks, all of the electrical and plumbing infrastructure of a mobile home park is considered part of the land improvements. Sewer lines and stuff are considered land improvements. All of those things can be depreciated over 15 years. Now, both tangible personal property and land improvements are also subject to bonus depreciation, right? So we're going to allocate on $1 million building, we're going to say we allocate, I'll show you an example, right? Well, this is on a $500,000 building, right? So on a $500,000 building, we took 20% land, 40% building, right? Well, now we were able to allocate 10% to 5-year assets. We allocated about 2.5% to the 15-year asset. That left $360,000 worth of building, right? What's the difference? Well, and this is not a great example because the difference is not that big. But you can see right here, there's a basically this is without bonus depreciation, right? Without bonus depreciation, the extra deduction is $7,200, right? Now let's look at it with bonus depreciation, right? So here's in a $2 million purchase, here's basically some losses that occurred, right? Now, we have earned income. The real estate professional on this example can take 120. Now he's got $80,000 worth of taxable income. The active investor was only able to take 25. The passive investor was not allowed to take any, right? See the difference, right? So it makes a big difference whether you're an active investor or whether you just qualify as a real estate professional. And the idea is you want to cost segregate properties when you have a lot of income to offset, and then it really makes a difference. Now, the other thing that you have to know about cost segregation is that you ultimately will have to recapture this depreciation when you sell the property, right? So when you sell the property, whatever depreciation you've taken, you now have to recapture. Okay, and what that means is you take it back in as income. What's cool about this, though, is that the maximum recapture rate is 25%. It's based on the rate you pay recapture on is based on your ordinary income rate. Okay, so if your ordinary income rate for that year is 15%, well, you're only paying 15% recapture, right? But the maximum it could be is 25%. So when I talked about taking big dollars down with cost segregation, like from 1 million to 600, and I'm deducting it at 33%, say for example, now when I go to recapture it, I'm only recapturing at 25. I've got an 8% spread. Not only did I get the time value of the money between the time I didn't pay the taxes and the time I sold the property, typically, could be 5 years, could be as long as you want to hold the property for, right? Not only did I get that time value savings of the money, but it's a real win when I can get the arbitrage spread, right? Now, correspondingly, if I use a cost segregation study to take dollars down from like two, so here, like this is a perfect example. I'm taking dollars down from 200 down to 80. So I've got $120,000. Now, ultimately, I'm going to recapture that $120,000. What if I have to recapture that $120,000? So here, I probably save something like 18%, right? But if I recapture it in a year where I made $400,000, now I'm recapturing it at 25%, right? And if I haven't held that for a long, long time, I actually lost money on that cost segregation study. So you never want to do a cost segregation study in two examples. One, if you have a short time frame for selling that property. So you don't do a cost segregation study if you're selling the property a year or two from the date you do the study, right? The other thing is if you expect, and this is why we do multi-year tax projections for a lot of people, if you expect your income to go up in future years, and you have determined that this particular property is a 5-year hold, but you know that your income is going to be much higher in year 5, well, it might not make sense to do a cost segregation study. Why? Because you're going to recapture at a higher rate than you got the tax savings on, right? And 5 years is a relative. If you're doing that and you're actually losing money on the arbitrage on the spread, then 5 years is not a long enough time for the time value of money to make up for that. Does that make sense? I hope that makes sense for everybody. All right.